Joining us now is Bilal Hafeez, Macro Hive CEO and Head of Research. Bilal, very nice to have you with us. So let's start with this China news, because one of the things that the market has increasingly become aware of is a slowdown in Chinese growth and concerns around the global growth story as a result. How significant is it if we see this kind of stimulus activity, but at the same time we still have COVID-0 policies in place?
I think this policy is important insofar as it tells us that the Chinese authorities want to do something to boost growth. And also in earlier days this week, we did see that there are some steps to ease up some of the lockdowns across China. So this is somewhat good news. But in the end, as you rightly point out, they still are pursuing the zero COVID strategy. And in the end, if you still have a zero COVID strategy, that will ultimately suppress demand going forward. So these things help, but in the long run, you need to lift the zero COVID strategy for a big rebound to occur.
Okay, Mark, jump in.
Bilal, I'm curious about what your long-term view is around China. Say, for example, on a 3-year horizon, are Chinese stocks going to outperform global benchmark? Let's just say CSI 300 versus MSCI World. Which will do better on a 3-year horizon?
That's a good question again. From a valuation perspective, certainly it does look like Chinese stocks should outperform. But from my perspective, I think that Chinese stocks will struggle. Part of that is because I think the structural picture for Chinese growth is quite poor. The economy is over-leveraged. They have a property bubble sort of dynamic. I think the regulatory backdrop isn't very supportive of equities. Then on top of that, I think the other issue is that the authorities in China, I think, care less about the performance of equity markets than say the US or European economies as well. So I think there's a bias in other regions to be more supportive for equity. So my bias would be that I don't think Chinese stocks will necessarily outperform the rest of the world in the next 3 years. Okay,
so that's the China story, and that takes us nicely into the way that you've been thinking about markets. And I read this with interest from your notes because I like your diverse range of influences here, Bilal. You take your influence here from Doctor Strange and the Multiverse of Madness, and you talk about how there are many, well, as the name suggests, many universes, a multiverse in that particular film. And you say it feels as if we're living in many universes right now, and China is one of those. China, with its COVID fight, is, of course, one of those. There's the tech universe, there's tragically war, of course, and then there's rampant inflation. And through all of that, you then say you want to be in cash, or what's the idea there? Yeah, so the idea here is that, you know, depending on which region of the world you're in, you're experiencing very different realities. So in China, it's still locked down, whereas in the rest of the world, COVID doesn't seem to be around anymore. In Europe, we're dealing with a war in Ukraine, energy shock and so on. In the US, it's just inflation. So each region has its own reality. But if you join all the dots together, all of them point to a very negative growth and risk environment. They're all bad things. So ultimately, that tells me that you should be careful of risk assets like equities, credit, crypto, and so on. And you have to seek refuge in cash in the end, because cash, while it doesn't give you much of a yield, at least it doesn't collapse by 20% in the space of a few weeks. Let's hope not. Bilal, then, do you think we're heading for a recession? And you can either talk about the universe that is the United States or all of the many multiverses we exist in at the moment.
Okay, we stick to the US universe. I do think we will get into a recession. I mean, the issue here is, of course, every economy will have a recession at some point. The question here is really the timing. Will it be this year? Will it be next year? Will it be the year after? We have a model where we look at the probability of recession based on the US yield curve. So we've built this model. And at the moment, it's assigning a 40% probability that the US will have a recession in the next 12 months. And my sense is that I do think there's a very high probability by, say, the first half of next year we'll be in the US recession. So I think we are in the zone where it's kind of on the horizon, but not necessarily in the next quarter or two. And one of the big drivers of that, I think, will be the Fed. You know, I think the Fed's messaging is very clear. They're going to do whatever it takes, even if it means a slowdown in the economy, to bring down inflation. And I think that will be one of the reasons for this.
Yeah, Mark, every time I ask a guest, are we heading for a recession, I always feel like it's a sensible and also a ridiculous question, because, you know, at some point in the future, probably, yes, we are.
Absolutely. I get abused, Bilal, whenever I say we're definitely going to have a recession. And you get away with saying we're probably going to have one in the first half of next year. OK, so we're heading towards a recession. How low is the S&P 500 going to trade? I want to have an exact level here and a bit of a reason for why. And I'm going to ask a follow-on bit. Does the Fed care about how low the stock market trades? I know they care about other parts like the credit market, unemployment, etc. But do they care how far low the stock market trades? But give me the level first.
Yeah, you want a level. I'll give you a very precise level, which of course will be completely wrong, but I think we will get down to around 3,500 by the end of this year. So quite a meaningful further decline. That will take us back to where we were in the summer of 2020. So I think we're in still for a meaningful decline in stocks.
Okay, and to Mark's point, then, do you think they care about stocks? We heard from Esther George overnight, didn't we, at the Fed, saying she was saying that a rough market, that's not going to alter the Fed's plan. So she seems to be suggesting there is no Fed put, they don't care about stocks. But do they really not care about stocks?
I think at this stage, I think they don't really care about stocks. And there's two reasons for that. You know, number one is if you look at household surveys in the US, the biggest issue households are facing are inflation, by far. It's like the worst inflation picture like in 20, 30 years. And you have midterm elections coming up. There's huge political pressure to deal with inflation. People aren't worried about their stock portfolios. They aren't worried about jobs either. They're worried about inflation. So that's number one. Number two, if you look at the composition of the Fed, they're much more concerned about the distribution of income as well. There's a shift in what the Fed looks at. And if you look at who holds equities in the US, it's the rich. It's a top quartile of households in the US are long equities. The middle are long property, and the bottom don't have any assets. So, you know, equities only really matter for the upper quartile, and they don't really spend much anyway. So I don't think the Fed cares as much about it as they did in the past.
So this makes complete sense to me. You're very risk averse. You, in fact, make me look quite optimistic. I know you favour cash as being quite important, but as a hedge against your risk averse view, which is the stock market that you'd most likely to be long of in your portfolio right now?
Yeah, if I had to be long a given sort of stock market, I'd probably think about somewhere like Japan. The reason I say Japan, because they have a central bank that isn't going to increase interest rates anytime soon, you know, notwithstanding they had a pickup in inflation, but their inflation is, core inflation still below 1% even. Their central bank is also buying equities there as well. And I think that there's a valuation story as well. So if I had to pick one, I'd probably pick Japan, but overall, I'd probably want to stay away from equities.
Bilal, thanks very much. Bilal Hafeez, CEO and Head of Research at Macro Hive. Thank you very much for joining us. Really good to speak to you about films and the markets.